and then we'll begin the official proceedings for the day. Thank you so much. Good evening, Excellencies, distinguished dignitaries, esteemed guests, ladies and gentlemen. On behalf of Embassy of India in Kuwait, I welcome you all to today's event, a discussion on the Union Budget of India for the financial year 2021-22, which the Embassy is organizing in association with the Indian Professionals Network Kuwait and the Institute of Chartered Accountants Kuwait chapter. This event is the inaugural event under the theme Invest in India, under which the Embassy intends to organize a series of investor outreach initiatives. In view of the prevailing pandemic, today's event is being held virtually in line with the COVID-19 health and safety guidelines and protocols. India and Kuwait share a close bilateral relationship which is underpinned not only by civilizational affinities and vibrant people-to-people contacts, but also by the strong, mutually beneficial economic ties. Trade has linked the peoples of the two countries for many centuries. However, despite the close bilateral ties, there are many synergies and complementarities that are waiting to be realized to their true potential. Today's event is an effort in that direction. The Union Budget of India for the financial year 2021-22 was presented by the Honorable Minister of Finance of India, Her Excellency Srimati Nirmala Sitharaman, on the 1st of February 2021. This is a pivotal moment not only for Indian economy, but also for the global economy, because as a major engine of global growth, the onus is on India to lead the way in the economic recovery post the COVID crisis. The budget, in this sense, spells out a roadmap for this economic recovery. To explain the budget in greater detail, today's event will feature 3 expert speakers, each of whom would cover specific segments of the budget for the benefit of the investor communities from India and Kuwait. Without further ado, I would now like to invite His Excellency, the Ambassador of India to Kuwait, Shri C.B. George, to come to the dais and deliver his inaugural address.
Good afternoon, everybody. Esteemed panel speakers of the event, businessmen from India and Kuwait, distinguished guests from the media community in Kuwait, ladies and gentlemen. It gives me great pleasure to address you all today and welcome you at today's event, a discussion on Union Budget of India for the fiscal year 2021-22. This event is part of the special series of investment promotion events under the theme Invest in India that the Embassy is organizing to facilitate inward investments to India. The Embassy has also been organizing a series of events under the themes Atmanirbhar Bharat, that is self-reliant India, and states facilitation. In the midst of crisis, every crisis, lies great opportunity, said the great scientist Albert Einstein. Today, we are in the midst of a crisis which has threatened the very existence of mankind. The ongoing pandemic continues to be a major global disruptor of health, human lives, livelihoods, and economies. And the humanity as a whole is still struggling to grapple with this challenge of unprecedented proportions. However, India turned this moment of crisis into a moment of opportunity. Honorable Prime Minister Sri Narendra Modi gave a clarion call for building a self-reliant India, Atmanirbhar Bharat. This initiative envisages a merger of the local with the global, an idea that ensures India's strengths act as a global force multiplier. How India turned crisis into opportunity can be understood from the following example. When the corona crisis started, there was not a single PPE kit made in India. The N95 masks were produced in a very small quantity. In a matter of few months, India was in a situation to produce enough PPE kits for its domestic use, and it became a net exporter of kits, N95 masks, and many of the medical equipments. Our COVID vaccine story is another prime example of how India led the way in handling the COVID-19 crisis. Our researchers and scientists at leading laboratories have risen to the occasion and have raced against time to develop effective two made in India vaccines, including an indigenously produced vaccine. This has enabled us to not only launch the world's largest vaccine drive, but also placed us in a position where we are able to supply vaccines to a number of countries in the world, especially the developing countries. I am pleased to share that Made in India vaccine Covishield has reached the friendly state of Kuwait. We are delighted to deepen and strengthen our partnership with the state of Kuwait in the fight against ongoing pandemic. Dear friends, many of you would be aware that the International Monetary Fund recently projected that India would grow by 11.5% in the financial year 21-22. This makes India the only major economy that is poised to post a double-digit growth amidst the growing pandemic. The sharp V-shaped recovery is the result of the conducive reforms and facilitation measures introduced by the Government of India to encourage greater global involvement. Government policies since 2014 have been directed towards bringing necessary structural changes in the economy. These efforts have been reflecting in the World Bank's ease of doing business rankings time and again. Last year, India improved by 14 ranks and jumped to 63rd position among the 190 countries. India has improved its ranking by 79 positions in the last 5 years, that is 2014 to 2019. Amidst the ongoing pandemic, India made history by successfully crossing $500 billion milestone in FDI equity inflows. India received $261 billion of investment between the period 2015 to 2020. Just to put things in perspective, in terms of flow of FDI into India in recent years, more than half the FDI of the past 2 decades has occurred during the period 2015 to 2020. All this points out to the one fact that the future of the global economy is linked to the performance of the Indian economy. India continues to be the major my engine of global economy, and global capital flows have reaffirmed this confidence in Indian economy. India's scale is extraordinary. By 2025, 1/5 of the world's working age population will be Indian. By 2030, there will be over 850 million internet users in India. By 2035, India's 5 largest cities will have economies of comparable size to middle-income countries today. There is no market over the next 20 years which offers more growth opportunities than India. The drivers of India's growth are deeply structural, which suggests they are also sustainable. Dear friends, the Union Budget 2021-22 is based on the holistic approach to growth and development adopted by the government. It is a watershed moment in our history as we reaffirm the arrival of New India, where the government has made a decisive move towards an investment-led growth model. Indian stock markets witnessed an increase of 5.12%, which is the highest increase in Indian stock markets during the 21st century budget day. It is also testimony to the faith of India Inc. on the government's reform agenda and vision. On the budget, Honorable Prime Minister stated, and I quote, "This budget lays a strong foundation for the new decade and is an important step towards Atmanirbhar Bharat. The budget carries the following principles: expansion of opportunities for growth, new opportunities for the youth, new meaning to human resources, new sectors for infrastructure development, progress towards modernization, and new reforms. It is a proactive budget that provides a boost to wealth as well as wellness," unquote. The market consensus is that it is a visionary and growth-oriented budget. Government has allocated funds to sectors with a strong multiplier effect. Proposed initiatives like creating infrastructure for R&D and skill enhancement in artificial intelligence will be a game changer for the economy and propel India to emerge as a global hub for both manufacturing and trained workforce in the decade. With the government showing the way, it is time for businesses and investors to seize the initiative and be a part of post-COVID-19 growth story. I will leave it to the panel of experts to delve more into the details of the budget and help us understand the nuances of from the point of view of experts and practitioners. I am sure that we will benefit from this discussion. Once again, I welcome you all here for this panel discussion. Thank you very much.
Thank you very much, Excellency, for the brief remarks which have now laid the foundation or the framework for today's discussions and deliberations. Before we begin the discussion on the budget, I would like to take you through a summary presentation on budget highlighting the 6 key pillars. Of course, I'll just be skimming through the presentation because the details will be delved into by our expert speakers of the day. The presentation will be up on your screens now. The Union Budget 2021-22 is the nation's first digital budget, which contains schemes to empower multiple sectors of the economy. This is a budget which comes in the backdrop of the COVID-19 crisis. In fact, to share some details of the fight against COVID, India continues to register lower fatalities, currently standing at 112 per million population. And the active caseload also continues to drop. It is currently at 130 per million population. We have 2 made in India vaccines, which are currently being administered to those in need across the nations and among partner nations. including the state of Kuwait. To overcome the effects of the COVID-19 crisis, the government implemented many mitigatory schemes, including provision of food grains to around 800 million beneficiaries, as well as free cooking gas and cash for the needy. The Atmanirbhar Bharat, which the initiative, which was a clarion call for the Honorable Prime Minister, also facilitated economic recovery from the pandemic. In fact, the Atmanirbhar Bharat, when combined with the liquidity and other monetary measures implemented by RBI, created a financial impact of around $371 billion. So, in fact, the vision that was expressed by the finance minister as part of the budget had 6 key pillars: health and well-being, physical and financial capital and infrastructure, inclusive development for aspirational India, reinvigorating human capital, innovation and research and development, minimum government and maximum governance. In the health and well-being sphere, we are talking about strengthening our healthcare ecosystems. We are talking about drinking water and Swachh Bharat campaigns and waste water management. We are talking about vaccine development and distribution. And in the physical and financial capital, we are talking about setting up or monetization of dedicated railway freight corridors, airports, operational toll roads, oil and gas pipelines, transmission assets of Power Grid Corporation, warehouse assets of central public sector enterprises, and sports stadium. Next slide, please. We are further in the component under inclusive development for aspirational India. We are talking about rural development programs, support to important sectors like agriculture and fisheries. In the pillar under reinvigorating human capital, we are talking about new schools, universities, promotion of apprenticeship plans. Under the key pillar of innovation and R&D, we are talking about the digital push, be it in DigiFinance space. We're talking about space exploration, open deep ocean programs. And when it comes to minimum government and maximum governance, we are talking about rationalizing, further liberalization, and structural reforms, the continued push towards structural reforms. So the expected impacts of all these 6 pillars and the various reforms under each of these pillars is expected to deliver good governance, greater public health, women's empowerment, inclusive development, and doubling of farmers' income. I had to skim through the presentation because I let the expert speakers then do the job of explaining each of the proposals under these 6 key pillars. Thank you so much. Now, before we begin our discussion on the budget, I would like to introduce you all to the guest honor for today's event, His Excellency Mr. Faisal Al-Zamil, an international banker of repute. He is also a founding member of the Board of Directors of Kuwait Finance House. He was also the member of Board of Directors at the Islamic Development Bank in Riyadh and Jeddah, at the Kuwait Fund, and at Kuwait Investment Authority. He is also a columnist in a prominent Kuwait daily. So with this, may I now request His Excellency Mr. Faisal Al-Zamil to come to the dais and deliver his remarks on the occasion, please.
Good afternoon, everybody. Your Excellency, thank you for inviting me to share this very unique opportunity to exchange and get more knowledge about this event of the budget of India for 21-22. As everybody know now, global economy have two major emerging driving power. It's coming from China and India. And with all of the consequence of this pandemic, development is still coming day after day. And the expectation we are building, it's always subject to be revised according to the changes in demand and layers and some barriers from time to time to be established in commercial or trade war or something like this, that in turn it will impact, put a pressure for local government's plan. But in my area of where I came from in development institution, Kuwait Fund and Islamic Development Fund and the rest of GCCs in the world, in 2008 we had the crisis in the money markets, and the reflect or reaction of those ECAs was different than the banks and the market itself. Actually, they, instead of withdrawing, they injected. Actually, they doubled their spending, and that make the crisis goes shorter than expected in 1929 compared with this great recession. It went in a very short time because of this kind of reaction. Such pandemic needs ideas like this, and especially in the area of infrastructure and development. For instance, China is spending hugely in Africa under this title of infrastructure and development projects under development. And those projects aim to be a commercial. When you say it's an investment, it's not an investment as long as it is paid back by the government. Yes, but it did give China a certain position within Africa. Without this kind of move, they wouldn't be, and now they are a major player in Africa. Kuwait Fund been established in 1961, just to compare with European Development Fund established in 1991. So you can see here, Kuwait have started this is such effort 30 years before Europe did. Why do we believe that? We believe that this kind of intervention, it is healthy for our economy. We're doing this on loan basis, but soft loan, longer term, 25 years, and assured by the government. Therefore, Kuwait Fund since 1986 did not get any fund from the government. They recycle the money they lend and get it back and keep everybody is benefiting. The countries are doing their infrastructure project, and they have the tax system to pay it back, but in a span of time, which is a win-win. And the same manner, IDB is doing this, but on Islamic countries in Asia and Africa, while Kuwait Fund is doing this in 105 countries around the world. And still, economic-wise and financial-wise, the entity, from this angle, when we talk about India and the region and elsewhere, from this angle of development, there will be a big role for a lot of Indian companies. Again, like the example of China. They did an investment but under the development, but it is actually an investment for the Chinese companies, where all of the project done, road and electricity, desalination, etc., it's paid back. Number two, in 1991, when the Berlin Wall fall down and Soviet Union turned out to be many countries, at that time there was a big shock for the economy, how to deal with this big change. Mainly Tajikistan, Turkmenistan, Azerbaijan. Those newly emerged countries, they don't have background in running financial policies and economic strategy. Turkey offered them what you call it, barter deals to build whatever they want to build. And I've seen this myself. I was there in 1996. There was nothing. I came 10 years later. It was different. Everything had been built by Turkish companies. In contra, they got the gas. They need the gas. They need their natural resources. And India have done the same with Malaysia. I think in 2005, a railway road from north to south of Malaysia, something like 800 kilometers, been built by Indian companies on barter trade. They get oil, palm oil, and as a payment method. So, and there are new ideas is coming during this kind of situation, and it's workable. And it's enhanced countries, again, in such situation we are in. Finally, for Kuwaiti investment in India, I used to be in Kuwait Investment Authority. We have 2 offices in the world, outside of Kuwait, in London and in Shanghai. In London since 1953. And yesterday in the newspaper, the British authority was asking, and they have kind of concern about what will happen to this office after Brexit. They told them, don't worry, we have already arranged our investment a couple of years ago according to this, and we are staying in London. In China, the office have been, they had a major stake in China Industrial and Commercial Bank, which is the largest in China. Number of the staff is 950,000. So you can imagine how big is this bank. And other stakes in China. I think in India, we have $5 billion investment, and we're planning, KIA, to raise it up to $20 billion in 2023. This is according to my search. I'm not in the office of KIA anymore, but and the time of China I was there, we've been in this detail at that time. So I think bridging between Kuwait and India is easier than China, not just because of the heritage and historical relation, which is way out back in the history, but also because of the nature of what Indian industry can afford. for example, in America, in every major town you will have a China town. You know, there are no India town, but actually they have Silicon Valley, they changed it to be Indian Valley now, which is a breakthrough, a big breakthrough in what is needed in this period. This what could be also done between Kuwaiti investors and Indian player in this industry, which is now the leader of the investment. And we hope that this turn from government side to a private sector to invest in this sector in India, which needs such kind of gathering and inauguration and exchanging a lot of efforts and enhancing. And I'm very happy what I've been told that the government have launched a policy to encourage foreign investors to come to India, and this to be highly publicized in Kuwait and the rest of the Gulf. And talking about the Gulf, it is a custom now, once an authority, investment authority, take a step, they exchange views over phone. We are going to A or B. You want to join us? No, not now. Okay, later. So they're kind of common coordination. So actually, when you talk to one, actually you're talking to mostly to the community, because the circumstances are almost the same. Barrel of oil increased, they have surplus, they need to spend it somewhere and invest it. Finally, thank you very much again for this opportunity you gave it to me, and hope this all the success for the Indian financial and economic situation.
Thank you, Excellency, for the succinct and informative remarks and for highlighting the complementarities that exist between the business ecosystems of the two countries. We will now move on to the discussion on the union budget. The first expert speaker for this discussion is Mr. Tuhin Chaturvedi. Mr. Tuhin is a partner in tax at RSM Albazi & Co. He is a chartered accountant and a fellow member of the Institute of Chartered Accountants, India. He has been an engagement partner for almost a decade in Kuwait with a leading Big Four firm and is a subject matter of expert on many aspects of tax. Without further ado, may I now request Mr. Tuhin to come to the dais and deliver his presentation. Mr. Tuhin will be speaking about the macro picture of the budget and its impact on India's growth.
So thank you very much, and good afternoon, Your Excellencies and distinguished guests who are present in the auditorium and who have joined us virtually over the internet. So thank you very much for giving us the opportunity to be present at this august platform. And thank you also to the Institute of Chartered Accountants of India and the Indian Professionals Network for also organizing this event. So, as Fahad mentioned, I'm going to talk today about the major themes which emerge from the Finance Minister's budget speech. So, next slides, please. Okay. So the major themes which emerge from the Finance Minister's budget speech, right, are essentially foreign ownership and the privatization of public sector enterprises, infrastructure financing and monetization, infrastructure investment. That is a very large thrust of this budget, both the financing and monetization of infrastructure and the investment in infrastructure. And then there are various provisions which relate to healthcare, manufacturing, and some other miscellaneous provisions. Now, before we move on to the provisions, right? I'd like to look at to just have a quick look at the figures, right? And this is a snapshot of the budget. So let's focus on the third column, which is the revised estimates for 2020 and 2021. So essentially, the revised estimates for the fiscal year, which is just ending. And here we will see that the fiscal deficit is at $253 billion equivalent, which is almost double the fiscal deficit of the previous fiscal year, FY20. The GDP has contracted by 7.7%. And as a result of the doubling of the fiscal deficit and the contraction of the GDP, we see that the deficit as a percentage of the GDP is estimated to be at 9.5% of GDP, which is again double the percentage of the previous fiscal year, FY20, which was 4.6%. So this is, of course, concerning, and we know that this has arisen because of the COVID-19 effect, because of the effect of the pandemic and the effect of the pandemic on the economy. Now, what is heartening to see is that for the next fiscal year, FY22, for which the budget is being presented, we are expecting, as the ambassador had alluded to in his speech, a GDP increase of 14.4% over the current fiscal year. We are expecting a slight decrease in the fiscal deficit from 253 billion to 206 billion. And as a result, we will be, the fiscal deficit as a percentage of the GDP will be reduced to 6.8% from the current 9.5%. A step, a very heartening note, and it would be a step in the right direction, which the finance minister envisages will continue over the short term. Okay, next slide, please. So we'll now turn to the key provisions in the finance minister's speech. And as I mentioned earlier, the theme which emanates from this is that, yes, there are certain specific provisions for foreign investors and non-resident Indians. There is an emphasis on the privatization of public sector enterprises. And then there is a huge impetus on infrastructure. And we'll look at all these in detail now. So the first thing is that as far as insurance companies are concerned, there is the finance minister has said that the limit for foreign direct investment will be increased from the current 49% to 74%. The incorporation of one-person companies will be incentivized in order to benefit startups, and non-resident Indians will also be allowed to set up one-person companies in India. Now, all of us are aware that at the moment in India, there is a lot of ongoing privatization, be that the privatization of Air India, of the Container Corporation of India Limited, of the Shipping Corporation of India, or of IDBI. Right? Now, while those privatizations are continuing, what we are being told is that the initial public offering of the Life Insurance Corporation of India will occur during the next fiscal year, FY22. In addition to the privatization of the IDBI, 2 public sector banks will also be privatized, and 1 general insurance company will also be privatized. And the focus on the privatization of the public sector enterprises will continue. The government has identified 4 key strategic areas only where privatization will not occur, but the government's presence will be reduced to the minimum possible. In all other areas, there will be maximum privatization, and a special purpose vehicle will also be set up to monetize the surplus land which currently belongs to the central government, the state governments, and the public sector enterprises. The receipts from privatization in the in the next fiscal year, FY22, are estimated to be $24 billion. Next slide, please. So that was some of the provisions relating to foreign investors, institutional and private. And we move now to infrastructure. So there is, first of all, in order to have all the infrastructure, or to satisfy all our ambitions relating to infrastructure, we need to look at the financing of infrastructure. So what the government has said is that they will set up a new development financial institution which will provide long-term infrastructure financing. Capital of about $2.7 billion has already been provided in the budget for this development finance institution. And the proposed loan book of this development financial institution will be at least $70 billion after 3 years. Foreign portfolio investors will be allowed to invest in the debt issued by infrastructure investment trusts and real estate investment trusts. The National Highway Authority of India and the Power Grid Corporation of India will each set up an infrastructure investment trust to attract both foreign institutional investors and domestic institutional investors. And as far as the existing infrastructure is concerned, there will be a very big emphasis, there is a very big emphasis and a thrust in order to monetize this existing infrastructure. So what do we mean by monetizing existing infrastructure? We mean that, okay, the infrastructure has been created and now the government needs to earn money from that infrastructure. So a good example would be toll roads, where once the highways have been created, the tolls are put into place and the revenue from the tolls flows to the government. Similarly, the government has said that the dedicated freight corridors which it set up, the airports, the transmission assets of the Power Grid Corporation of India Limited, oil and gas pipelines, and even sports stadiums will all be monetized so that revenue starts flowing from those infrastructure assets to the government. Next slide, please. So once we've looked at the financing of infrastructure and the monetization of infrastructure, let us now turn our attention to what the plans are for infrastructure in future. So at the moment, there is a national infrastructure pipeline which has about 7,533 projects. And the total project cost, their total project cost is almost $2 trillion. And as you will recall, this $2 trillion is almost 67% of the gross domestic product of the country for the current fiscal year. Now, yesterday I was looking at the internet and I was pleasantly surprised to see that there is a website for this national infrastructure pipeline, which is updated in real time and shows us how many projects are there, what new projects have been added, what is the completion of each project, what is the total amount. That is from where I've got these statistics. And it also allows us to drill down on a project by project basis. So that is the amount of transparency which the government of India has put in place today, which is really heartening to see. Right. Now, capital expenditure and the budget has been increased to $76 billion, which is an increase of 35% from the previous budget. And we are now going to look at, we talk of infrastructure, I've spoken generally of infrastructure. Let us see what are some of the specific examples of infrastructure which the government has in mind. So the first example is roads. In roads, we currently have a Bharat Bala Pariyojana project. It's an existing project which is worth $73 billion, under which 3,800 kilometers of roads have already been completed. Now, in addition to this Bharat Mala Pariyojana project, the current budget has announced that there will be 6,500 kilometers of additional roads which will be developed as economic corridors. Then, when we come to railways, a future-ready railway system will be created by 2030. Western and Eastern dedicated freight corridors will be ready by June next year. Further corridors are planned. And in this budget, there is a record allocation to the railways of $15 billion. Next slide, please. Another example of infrastructure is urban public transport. Now, the budget states that private sector players will provide 20,000 buses under a public-private partnership model. And $2.5 billion have been allocated under the budget for this scheme. Metros will be introduced in Tier 2 cities, and new technologies, Metro Light and Metro Neo, will be deployed in order to ensure that the new metro systems are more efficient and are more economical also. We then turn to power. And what the budget has said is that it's identified that the distribution companies are the weakest links in the chain of power. So the budget mentions that a new power distribution scheme will be launched, which will assist these distribution companies, or DISCOMs as they are called, to purchase infrastructure, smart metering, new systems, and an amount of $42 billion has been allocated for this new power distribution scheme over the next 5 years. There is also a national hydrogen energy mission which will be launched in the next fiscal year, and the purpose of this hydrogen energy mission will be to collect hydrogen from green power sources. We then turn to ports and shipping, and the budget also introduces a major change in ports. It says that from now on, the major ports will not be doing all their activities by themselves, but they will now be servicing all their activities under a PPP, public-private partnership model. There are 7 large new major projects for the major ports. The flagging of merchant ships in India is also to be promoted, and the current capacity to recycle ships, which exists in shipyards in Gujarat and amounts to 4.5 million light displacement tons, will be doubled during the next fiscal year. Next slide, please. So we've looked at the 3 main themes till now, right? We've looked at provisions specifically tailored to foreign investors. We've looked at the privatization of public sector enterprises, both central and state. And we've looked at the major thrust on infrastructure and infrastructure development, right? Now, I mean, needless to say, all these initiatives of the government represent very significant opportunities for foreign investors. Because of these particular projects and the kind of money which the government is going to put behind these projects, they represent a significant opportunity for foreign investors to engage with these projects and to invest in India. We look at three other significant pronouncements in the finance minister's speech. So one is there's a new scheme called the Pradhan Mantri Atmanirbhar Swasth Bharat Yojana, which essentially means Healthy India Plan. And an amount of $9 billion over 6 years is going to be allocated to this new health scheme. Universal water supply will occur in all the urban local bodies. This is called the Jal Jeevan scheme, the water and life scheme. And an amount of $39 billion has been allocated to this scheme over the next 5 years. So this was health, water, and then the focus continues on waste management, on the reduction of pollution, through a scheme called USBM2, which is the Urban Swachh Bharat or Clean India Mission 2, to which $19 billion has been allocated over the next 5 years. There is also an ambition expressed in the budget speech of allowing the manufacturing sector to grow on a double-digit basis over the next 5 years. In order to accomplish this, a production-linked incentive scheme will be put in place over the next 5 years, and an amount of $27 billion has been allocated to this production-linked incentive scheme. 7 new textile parks will also be set up. After that, we have a number of miscellaneous provisions, which are again very interesting, so I will run through them. There is a world-class fintech financial technology hub, which will be created at the Gujarat International Finance Tech City, the GIFT IFSC. Regulated gold exchanges will be set up. 5 major fishing harbors will be developed, including Kochi, Paradip, and Vishakhapatnam. So 5 major fishing harbors will be developed as economic hubs. There is a national research foundation which will be started, which will have an outlay of $7 billion over the next 5 years. The budget has financial incentives to promote digital payments. And finally, a deep ocean mission will also be launched. Next slide, please. Thank you. Yeah, so thank you once again. Thank you for your attention. And these are essentially the highlights of the finance minister's speech. Thank you.
Thank you, Mr. Tuhin, for lucidly summarizing the big macro takeaways of the budget. We'll now move on to the second expert speaker of the event. Our second expert speaker of the event is Mr. Sunil Gidwani, a partner at Nangia Anderson Consulting Private Limited. Mr. Sunil has deep expertise in domestic and international tax and regulatory matters with a focus on financial services sector. He was a partner with PwC and has over 25 years of experience in advising banking and non-banking companies, stockbrokers, asset management companies, PE funds, mutual funds, hedge funds, foreign portfolio investors, sovereign funds, and other institutional investors in capital markets. Mr. Sunil will be joining us virtually from India. He'll be speaking about the incentives offered in the budget for investors from a fiscal or tax perspective. To elaborate more on the theme and deliver his presentation, I invite Mr. Sunil Gidwani to deliver his presentation. Mr. Sunil, the floor is yours.
Thank you very much. Good evening to all the participants, and my big thanks to the host, the Indian Embassy, and the Kuwait chapter of the Institute of Chartered Accountants. Pleasure to be presented. Really love to really present there. The presentation, I guess my presentation is good to all the team. As you can see, of my presentation is the red carpet for foreign investors. The reason for this is I've never seen in the recent past few years that so many incentives being rolled out to investors at once. Uh, Incentivization began a couple of years ago, but in this year, whatever minor impediments were there, have all been so let me just look at my presentation. So in the previous presentation, we heard about the very insightful data point on his presenters on various topics ranging from what makes India as a very attractive investment jurisdiction, how the Kuwait institutional investments have evolved over the years, and various macroeconomic data points from previous speakers. So I will then skip some of these data points. Since and this is about Kuwait investments currently being made in India, and we heard about this at length. And as you can see that there is a wide range of multiple classes or categories of investments happening into India in multiple asset classes. The list of funds that you see on the right are either ranging from private equity funds or real estate funds, and also the other Islamic funds, which are investing in various asset classes in India. Many of them happen to be also Sharia compliant funds, and therefore, obviously, India does offer enough opportunities to make investments in India in the Sharia compliant manner. My focus is primarily on the financial markets or the institutional investors, and therefore I would just like to convey two messages so far as the financial ecosystem is concerned. We heard that the Indian budget is based on 6 pillars, and one of them happens to be financial infrastructure. So therefore, this year again, the thrust is on making structural changes in the financial ecosystem. The entire exercise began a couple of years ago when the GST system was introduced, when the insolvency ecosystem was introduced. But this year again, there are several announcements which in the form of either setting up a bad bank, which will resolve the NPAs of the various banks, or setting up a new ARC, which will take over NPAs of public sector banks, or giving a boost to the Indian International Financial Services Center. And again, further insolvency process is being strengthened further. So on the one hand, the financial infrastructure is being strengthened further. On the other hand, since we also heard about increased fiscal deficit and the fact that the government has not introduced any new levies in the form of taxes, it is obvious for the government to rely on alternate sources of funds, fundraising for its increased capital expenditure and the thrust on infrastructure. And those funds are likely to be raised from in the form of borrowings, divestments, and foreign investment. And since there is an increased dependence on foreign investment, major incentives have been rolled out to foreign investors in various forms, which is what I will go into. So before I go into the proposals which are contained in this year's budget, let me just spend a minute or two on what the current tax regime is, so that we can appreciate what the new developments will be about and how important they are. So currently, as we know, whenever a foreign investor invests in India in the form of various asset classes, the tax generally payable on gains that the investor makes on divestment or exit is in the form of listed equity, unlisted equity, derivatives, or debt. The current tax rate is largely 10% for long-term investment, and long-term doesn't necessarily mean very long-term. From tax perspective, it means holding listed equities for 1 year, unlisted for 2 years, and debt for 3 years. depending on the nature of investment. And the short-term capital gain tax is 15% or 30%. So this is broadly the capital gains tax regime. On dividend, the one ends up paying tax at the rate of 20% in India, which obviously substantially gets reduced based on the tax treaties that India has with various countries. And interest income is largely taxed at 5% withholding tax in India. So there is no change in this budget on these tax rates. So the tax rates remain same, and that by itself is a big relief for the foreign institutional investors. India has a tax treaty with over 80 countries, including Kuwait and some of the other GIC countries that I've listed. And for the sake of comparison, I've included Mauritius so that you can see that capital gains from shares is now taxable in all the countries, and for debt and derivatives it's exempt, and the withholding tax is either 5 or 10%. And on interest, it's again 7.5% to 10% or 12.5% from these countries. In the light of this, I have identified 5 major areas which are a must to know for any foreign institutional investor. So that relates to sovereign funds, like some of the sovereign institutional investors we heard about based in Kuwait or elsewhere, and managing funds from India. And the third area is the International Financial Service Center that has been set up in India a couple of years ago. And then foreign portfolio investors, and lastly, insurance sector. So to begin with, so far as sovereign investor funds are concerned, last year India introduced a major tax holiday for investors investing in infrastructure in India. So in this, one authority has been specifically named, which is RDA of UAE, and the other sovereign funds or pension funds, which meet certain parameters, will be notified by the government. The eligible investments, as you can see on the right, are investments in infrastructure trusts, investment in infrastructure companies, and the Indian Alternate Investment Fund, which are investing largely, or rather 100% in infrastructure projects. So these were the conditions which some of these conditions were found to be a little onerous, especially the one on the right, requiring the investment holding companies or infrastructure owner companies to be 100% engaged in infrastructure. So those have been now relaxed, and therefore now, even if the SPV or the holding company holds only 75% in infrastructure, that will qualify. Similarly, AIF holding 50% in infrastructure will also qualify, and so goes with the NBFCs, which are lending, non-banking financial institution which lend to infrastructure sector. Even if they're 90% assets are in infrastructure, that will qualify. So therefore, that gives a much needed flexibility in terms of holding any other asset or any other business in these investee companies. The income which gets exempted, or the tax holiday, expands to almost all categories of income, whether it's in the form of dividend, interest, or capital gain when one exits, so long as the investments are held for 36 months. And the tax holiday is open-ended in the sense that so long as the investment is made in this period, that is till March 24, the tax holiday will remain live for the entire holding period. And the conditions which were required to be set up, to be satisfied by the sovereign funds or pension funds were laid down. Some related to the fact that the sovereign fund should be entirely owned by the government of that country. So that has now been relaxed. Earlier, it meant that the sovereign fund could not even leverage, could not borrow. But now that has been restricted only to the Indian investment, which means that so long as there's borrowing which is used for any investment outside India, that should be okay. This was introduced initially to ensure that the benefits of Indian tax holiday do not flow to any private sector, private person. So therefore, now that has been narrowed down to ensure that the borrowing is restricted only for the Indian investments. Similarly, earlier there was a condition that there should be no commercial activity in India outside India. Obviously, that was not easy to satisfy because several sovereign funds have multiple forms of presence in India or investments in India, and so therefore that has been relaxed. And the only condition that has been put is that you can appoint a director, and you cannot be participating actively in the operations of the Indian investee company, and therefore you should remain to be a financial strategic investor. And on the right, as you can see, for provident fund, there was a condition that these funds should not be liable to be taxed in their respective country. That has been relaxed to provide that so long as they are liable, but subsequently, even if they are exempted from tax in their respective country, will now be eligible for such investments. Moving to managing funds from India, a couple of years ago, India introduced a regime whereby one could set up a fund manager in India, or an Indian manager could set up an offshore vehicle whereby the fund could be managed from India. And this safe harbor was basically to ensure that though the fund is managed entirely from India, it does not create any taxable presence in India. And therefore, the safe harbor was introduced to ensure that if you satisfy certain conditions at the fund level, which are largely in the form of investor diversification and the investment diversification, and similarly certain conditions to be met at the fund manager level, then the Indian Revenue Authority will approve the structure, and once the structure is approved, then the fund is not exposed to any additional taxes in India. Many of these conditions have been relaxed in the recent past, and therefore, in particular, if you see category 1 of FPIs, foreign portfolio investor, which are largely investing in the Indian listed market, will find it relatively much easier to satisfy these conditions, because many of those conditions have been relaxed for that category, and therefore now it is very much practical and possible to satisfy most of the conditions and avail of this tax holiday. What the budget proposes now is that if the Indian manager is set up in IFSC, then many more conditions may be relaxed, and those conditions are likely to be notified in a short while. So therefore, this entire safe harbor regime of managing an offshore fund from India is likely to be more attractive and easy to implement. Thirdly, the various incentives that were extended for setting up a unit in IFSC were also extended to a fund that can be set up in IFSC area. So if you have a fund in IFSC and you have a manager in IFSC which has investors from overseas, then for such fund and the investment manager, there are several tax holidays. So the fund manager does not pay any taxes; it doesn't pay any GST. Similarly, at the fund level, there are incentives. So, for example, particularly if there is a Cat3 AIF, which invests mainly in listed space, will get a tax holiday. And also, as I mentioned, there are other benefits. And the biggest advantage is that instead of availing of a safe harbor, which we talked about earlier, you could easily manage funds from India if you go under this regime, which is relatively easier to implement. And what the budget does now to this structure is that it says that if you have an existing offshore fund and you want to relocate to IFSC, then that can be done in entirely tax neutral manner. So if you have an existing fund investing in India, all you have to do is to transfer Indian portfolios to that fund which you set up in IFSC, and that fund issues its own unit to the investor. Therefore, the whole scheme can be implemented in a cashless manner, and this whole implementation will be tax neutral for the fund as well as for the investors. If there is under the respective treaty, any capital gains were grandfathered for the existing investments, or the investments were grandfathered to ensure that there are no capital gains tax under that respective treaty, then that will also continue after this new structure is implemented. And this basically ensures that you lose nothing by relocating the offshore fund to India, and also some of the other benefits or restrictions which are there for the investee companies. For example, if there is a change of shareholding, that sometimes the Indian investee company loses the right to carry forward losses. So that also gets protected, which effectively means that you can just migrate or re-domicile an offshore fund to India without any cost and with all the existing benefits continues. One additional benefit that has now been extended for banks that operate in IFSC is that if you set up an offshore banking unit in IFSC and that invests in the Indian markets, either in the form of derivatives or debt market, then that gets a tax holiday. So the way an existing international banking unit gets a tax holiday for operating in IFSC will also get extended to investments made as a foreign portfolio investor in the Indian stock rupee markets. And that also attracts lower withholding tax on interest and dividend at the rate of 10%. Next is the foreign portfolio investors who are currently investing in India were liable to dividend withholding tax on dividend at 20%. So that has now been clarified that they can also avail of treaty rates. In India, we have several treaties where we saw earlier that the withholding rate under the treaties ranges between 10 to 15 or 5, 10 or 15%. So that rate will also now be available. Therefore, the Indian companies which are paying out dividend need not deduct tax at the rate of 20%. So that's a big relief the industry was expecting, and that has now been clarified. Similarly, we saw earlier through the other presenters that the SEBI regulation will be amended to allow foreign portfolio investors to invest in infrastructure trusts and the REITs in India. And also the banking units that we saw earlier can make investment under the FPI route and avail of a tax holiday. And lastly, the insurance sector, the FDI limit has been increased from 49 to 75%. We will of course have to wait for the insurance regulations to be changed and the notification to be issued to make it effective. And this is something likely to be picked up by various players because several of the Indian insurance companies are formed in the form of JVs with the Indian partner and the foreign partner, where the foreign partner is currently holding 49%. So I'll skip some of the last few points because they relate largely to the tax parity between some of the insurance product and the domestic mutual fund products. So this is all I had to say. I'll be happy to answer any questions in the Q&A session. Thank you.
Thank you, Mr. Sunil, for providing a comprehensive analysis of the fiscal incentives provided in the budget for the investor community. Now we'll move on to the third speaker for today's event. Today's third speaker for today's event is Mr. Sanup Unni. Today's third speaker for today's event is Mr. Sanup Unni. He is a senior portfolio manager at the National Bank of Kuwait. He is a senior portfolio manager at the National Bank of Kuwait. Apologies, we are facing some technical glitch. I'm just waiting for a go-ahead from my technical team here. Okay, Mr. Sanup is an experienced emerging markets fixed income sales and trading professional. He is responsible for managing one of the largest AFS books in the region of fixed income securities. He was awarded the most astute investor in Asian G3 bonds for the years 2018, 2019, and 2020 by Asset Benchmark Research. Mr. Sanup is also joining us virtually. He'll be speaking about the budget from the perspective of a capital markets participant. I now invite Mr. Sanup Unni to deliver his presentation. Mr. Sanup, the floor is yours.
Thank you very much, Fahad. Yeah, so first of all, I would like to take the opportunity to thank His Excellency, the Indian Ambassador to Kuwait, Sri CB George, for giving me with this opportunity. Can you guys hear me?
Yes, we can hear you.
Yes, we can hear you. Thanks, Fahad. So, well, I'm going to speak from the perspective of a foreign institutional investor on how he would look at investing in India given the budget for the financial year 2021-22. I think I just want to take everybody through what happened before the budget was announced. I think we saw the Nifty, the Sensex equity markets drop by about 6 to 7%, partially because global markets were getting sold off during that week. And also the expectation from Indian markets from institutional investors was a weak macro background. And the expectation from the budget was that there would be spending, but that would get funded through either additional taxes or maybe there would be reduced spending, right? Because the whole theme was that the government would look at trying to constrain the fiscal deficit within the 3 to 4.5% of GDP, so that from a rating perspective, the ratings could be maintained. But what ended up was a totally bold step by the government to come up with such a budget. We saw a pro-growth budget, and pro-growth in the sense that the spending was mostly on long-term projects, including infrastructure. Obviously, this was not going to get funded by taxing, by creating additional taxes, but this was being funded and which would result in higher deficits. And what we saw, obviously, as a result of that, equity markets rallied by about 5% on that day, and then we've seen them rally, the rally continue. But obviously, the higher deficit has resulted in the debt market getting sold off approximately 15 basis points, because obviously there would be more borrowing from the government, and this should obviously result in the bond yields moving higher, and which is what we saw. What were the key highlights for me as an institutional investor who's looking to invest more into India? Well, the deficit was pegged at 9.5%, and I think a lot of people have already said that this is almost double of what it was the previous years. But for 2021-2022, we're looking at a potential fiscal deficit of 6.8, which I think is absolutely acceptable, simply because this deficit is being used to fund growth. And let me reiterate that as an institutional investor, we invest in India for the growth potential and not for stability. I mean, for stability, we would look at a developed market, but for growth, we would look at markets like India. So we want to see a growth-oriented economy. The other significant highlight for me was the fact that the gross government borrowing for the financial year 22 was pegged at around 12 lakh crores. We have the asset monetization program, which is great, which is one way of how they would fund this growth. The FDI cap in insurance sector is being raised to 74%, which means more foreign institutional investors into insurance sector, which means positive for the companies in the insurance sector. The fiscal consolidation timeline, which was to bring the fiscal deficit level below 4.5% of GDP, is now being moved to 2025, 2026, and that's absolutely acceptable. To fund the infrastructure projects, the idea of a DFI with a capital of about 20,000 crore, and to create a lending portfolio of at least 5 lakh crores within 3 years. This is great news for the financial sector, as far as I'm concerned. Okay, let me look at specifically what was there for capital markets. And for me, creating a bad bank to consolidate and take over existing stress debt is a move that has been contemplated by a lot of foreign governments, and it has been also talked over in India in previous years. But this time we actually have it. This is a great move simply because if we want to have growth in India, it cannot happen unless and until banks lend out. And the biggest reasons why, especially the PSU banks, have been underperforming has been precisely for two reasons. One, they do not have enough capital. The reason why they do not have enough capital is also because they have a lot of NPLs, right? So you are solving two problems here. One, you are recapitalizing them by putting in another 20,000 crore. And you are also now taking away those bad debts on their books, which reduces their NPLs plus the recapitalization. So you will now see suddenly banks having a lot more capital, a lot less NPL ratio, which can be used to lend out. The third point for me, which was significant, was the amendment to the LIC Act, which could eventually pave the way for an IPO. Obviously, the FDI, which I just mentioned, is pro capital markets news. And there were some amendments to the procedures and TDS related aspects for NRIs and for institutional investors, which was which was explained in detail by the previous speaker. Let me specifically come to what were the positives for equity markets. Obviously, higher capex spending is pro equity markets. The fact that there was no new direct taxes was great news simply because the expectation before the budget and the sell-off that resulted was that there could be some form of new direct taxes. So the fact that that didn't happen was ended up being positive. There was also an expectation that there could be some tax on capital gains, but since there was nothing of that sort, again, it was positive. We have been seeing the Q3 earnings that have started to trickle in, and they have most of them have been above consensus estimates. And we have seen the leaders, especially in these cyclical sectors, have seen a very good earnings quarter. And therefore, for me, in summary, what an institutional investor like me would be doing is that we would be assigning a much higher valuation premiums to the FY22 growth. What this means in layman terms is that if you look at the current PE ratios in the market on equity markets, you might see them at a high level. But what the market will do, or what institutional investors like us will do, is we will look at the FY22 earnings, and then we will try to calculate what is the PE based on current price. And if that looks low for us, that for us is an incentive to go into the equity market more. And that's what I mean by saying that we will assign a higher valuation premium to FY22 growth. Debt markets. Now, this is the most interesting part. Obviously, if you have a government that's going to borrow more, you're obviously going to see the yield curve move higher. What are the two big points for me? Well, the FY21 fiscal deficit, you're going to see an additional 80,000 crore. The FY22 gross borrowing targets will be about 12 lakh crores. And this means that if the yield curve has to be managed, the Reserve Bank of India will obviously have to come in to support the market through an open market operations. So in summary, what am I expecting from the debt market, given that there's going to be significant supply? I definitely think that there would be the rates would definitely be rising in the next few quarters. However, I don't expect the entire curve to widen. I would expect it to rise, but with a flattening bias, which means the curve would, the long-term curve would be more flatter. It will rise, but it will be more flatter. And I do not see the credit premiums, which is which is basically a non-government entity when he has to come and borrow. The premium that he pays over and above the government yield curve. That's what we call credit premium. I do not see that credit premium rising sharply. Okay. what I've tried to do here is I've tried to show you what was the 10-year Indian government GSEC yields. Last 6 months is the chart on the left hand side, and last 5 years is the chart on the right hand side. If you look at that spike on the Feb 2021, that's basically the spike that we have seen since the budget was announced. But please see that in context. That number is still somewhere around what the yields were in September 2020, which is about what we're talking about 5-6 months ago. And let's put things into context as to what the yield curve has done over the last 5 years. We were around 8% somewhere in 2019, Jan maybe. And from 8%, we have dropped all the way to about 6%, right? And this is good news simply because if I want to borrow more money, one, I am borrowing more money at cheaper rates, first thing for me. And second, if I have any existing debt which I had issued in the past, which is going to mature today or in another 6 months, and I need to refinance them, I'm now going to be refinancing them at a much lower rate than what I used to. And this will obviously start impacting my debt service ratios, and I'll come to that. Okay. I just wanted to put things into global perspective as to what kind of recovery India has had compared to the world. And I think we really have had a V-shaped, probably everybody else has had a U-shaped recovery, right? And why is that? And why is that we have had that? If you look at our net FDI, it's increased from 12 billion in the fourth quarter of FY 2019-20 to about 24 billion in Q2 2020-21. Let me tell you, by the way, in Q1 2020-21, this FDI was almost zero to negative. So just to put things into perspective, but then in the Q2 quarter, we have had 24 billion coming in from FDIs. Q2 would typically be, I mean, July, August, September kind of a number, right? So that's a significant thrust from the FDIs into the Indian market, because that's the point when they saw that the Indian markets were undervalued. And if you want to be in a growth oriented country, and there's only few of them in the world these days, this was the best opportunity to put it. This 24 billion, by the way, represents hardly 4% of our GDP. So there is way more room for more FDI investment. Our debt service ratio is just around 9 to 10%. Our external debt to GDP is around 22%, which is significantly low. And our short-term debt to reserves is about 19-20%, right? So all these matrices are in favor for India. So this is basically what I wanted to share with you guys. In terms of if you're an investor who is looking to invest, where would you invest if you have capital to invest in India? Obviously, my answer would be go 100% equity, because debt definitely is not going to return. It's going to be much lower returns in debt than in equity markets. However, there are institutional investors who cannot invest in equity, right? So obviously, then you need to look at debt. If you're looking at debt as an investment for generating returns, it is time for you to reduce your duration. You need to go less than 1 year or even 2 to 3 years, simply because you're going to see the yield curve pick up, and it is far more prudent for you to go short term and not lock yourself to a long term rate right now. So go short term, put in your money for 1 or 2 years, and then as it matures, obviously the yield curve by the time would have moved higher, and it is much more beneficial for you to then reinvest at those higher rates and generate higher returns. So that would be my advice to people who are looking to invest into Indian stock market. We are done with the budget, and I think things from a very short term, for the next 3 to 6 months, I'm expecting market to correct. So if you want to play that short-term theme, go for the debt market for another 3 to 6 months time. You might see an equity sell-off. I think the base for Nifty, where I see significant support, is 13,500. So if you start seeing markets correcting to 13,500 levels, start putting your money into equity market, and with every low point, start investing. Uh, but my logic is very simple. I would put it in equity markets in India for the long run. I'm just looking for an opportunity to see if this market cools down a little bit, and for that I might just wait 3 to 6 months. So that's my message, and thank you very much for listening to me patiently. Thank you.
Thank you, Mr. Sanoop, for an insightful presentation and also for reaffirming the fact that India is the destination for global capital. With this, we come to an end on the formal presentation segment of our discussions today. We'll now open the floor for a question-answer session. The floor is open to all our virtual participants. Please raise your hand, please. Please click the button which shows the icon of raising the hand, and then we'll unmute you. We've also received a list of questions over the chat window. In case we have someone raising their hand, we'll go with that, or else I will start with the questions that have been texted to us. Okay, so the first question that we've received is this: over the long term, what is the fiscal deficit that is expected? I mean, as a percentage of GDP. I invite Mr. Tuhin, who is here with us, to answer this question.
Yes, so the long-term fiscal deficit percentage, which had also been alluded to in one of the presentations, is 4.5% in the fiscal year 25-26. That's the long-term percentage. Any other questions?
Yes, we do. We do have questions. Meanwhile, do we have any one of our virtual participants who have raised their hands? Okay, so we move on to the next question that we had received. This is again for you, Mr. Tuhin. You had referred to the Deep Ocean Mission, or the program in one of your slides. One of the participants want to know what exactly is that.
Okay, so that's a very nice question. Thank you. The deep ocean, so what the budget speech says is that we have a large amount of sea resources of the ocean, which has not been explored by us in detail. So the deep sea mission is a mission which the government is putting in place to allow the detailed examination of our marine resources, and to allow us to go in depth and detail to depths which we have never gone to before, and to research these marine resources and to see what sort of ecological changes have taken place over time and the effect of climate change. And we've also got something in the budget speech on the seaweed farm, and there is the seaweed farm in Tamil Nadu, and there is, as part of this deep sea mission, we may also have an investigation into what would be the impact of seaweeds and seaweed cultivation on reducing the effect of climate change on the oceans and seas. That's the deep sea mission. Thank you. That all?
We have two more questions. I think one of them is directed towards Mr. Sunil Gidwani. May I request you to stay on the dais, Mr. Tuhin? Yeah. This question is for Mr. Sunil, of course. The question is, tax incentives have been given to move offshore funds to IFSC. But do you think it will be well received by the industry, and how easy it would be to move these funds? Mr. Sunil?
Yeah, sure. So clearly, I think it all depends on the category of the offshore fund. So if it is a global fund with investments in several countries, obviously it's going to be difficult to move only the India portfolio to a new fund in India. But if it is an India-focused fund, and especially the ones which have been launched or set up by some of the leading Indian fund houses, then that's a major attraction. I mean, then it'll be easier to move. But at the moment, we are all waiting for the regulatory changes to happen. So what has happened is the tax neutrality, but we are hoping that the Central Bank of India as well as SEBI will come out with the regulation to facilitate such a transfer.
Thank you, Mr. Sunil. So we have one more question. FDI in insurance is proposed to be increased to 74%. When will the decision be implemented, and are there any other measures to be put in place by the government before one can actually increase it to 74%? Would you like to take that question?
Okay, I can, that's for Sunil, right? But I'll try to take it. Okay, so Sunil's, is this working?
We would invite Mr. Sunil.
No, it's okay.
Okay.
Okay. So what could you repeat the question, please?
Okay. So essentially, it talks about insurance and
Right,
the increase in FDI limit to 74%. The participant wants to know whether there will be any other measures that would be put in place by the government before one can actually reach to this 74% limit.
So I think Sunil mentioned it in his presentation. And what he said was that even though there is a statement in the budget, we will need to see legislation, specific legislation, and there is an insurance act. I don't remember the year. There is an insurance act which needs to be amended in order to allow this change to happen. So Sunil also mentioned that amendment will need to go through Parliament. Right,
Just to add to that, the government also they also made it clear that they are likely to come up with some safeguards so that the control in connection with control and management, they want to retain control and management with the Indian partner.
Right.
Thank you, both of you. We have one virtual participant who has raised his hand, Mr. Suresh Wagmare. Mr. Suresh Wagmare, please go ahead.
Yes, good evening, sir. Yeah, good evening, sir.
Good evening.
Thank you for arranging a nice discussion on Union Budget 2021-22.
Please go ahead with your question. Thank you.
Yeah, my question is relaxation to NRIs, rules to remove hardship of double taxation. What does it mean to us?
Okay, can I direct this question to Mr. Sunil Gidwani?
Yeah, so I'm not sure in what context the question is being asked, but basically, the purpose of double tax treaty is obviously to ensure that the same income is not taxed twice in the home country as well as in India. One change that has happened and that refers to this particular aspect is that wherein an Indian who's an NRI who returns to India and becomes a resident, and he gets some retirement benefits from a retirement fund in the home country like Kuwait, when he encashes that gets currently taxed in both the countries, Kuwait as well as in India, because in India he's become a resident. So there is a change to that effect that it'll if it is getting taxed in the home country, then it will not be taxed in India. And the other change that happened is that currently there is a reference to the fact that only if a person is liable to tax in the home country, he will be regarded as a resident in that country, and therefore accordingly he will get benefit of the treaty of avoiding tax in both the countries. So that has been changed.
Right. So Sunil, I'll just add on to the first part of your answer. In Kuwait there is no personal income taxation. So if that person gets any retirement benefits, etc., those would not be taxed in her or his hands, right? But of course, what you've mentioned would apply to other countries other than those in the GCC which do not currently have personal income taxation.
So,
Mr. Wagmare, I hope that answers your question. Okay. So I think we don't have any other virtual participants raising their hands. So thank you, Mr. Tuhin, for
Thank you
joining
very
me in
much.
answering these questions.
Thank you.
Please take yours.
Thank you. Thank you.
Yeah. Ladies and gentlemen, with this, we come to the end of today's event. On behalf of the Embassy of India in Kuwait, I extend a formal vote of thanks to our guest of honor, to our event partners, Indian Professionals Network Kuwait, and Institute of Chartered Accountants of India Kuwait chapter, particularly its president, Mr. Kaiser Shakir, to all the esteemed expert speakers on the panel today, Mr. Sunil Gidwani, Mr. Tuhin Chaturvedi, and Mr. Sanu Punni, the business and investor communities from India and the state of Kuwait, respected members of the Indian diaspora who have joined us today on the virtual platform, distinguished guests and viewers who are also watching us live on Embassy's social media platforms, and esteemed members of the media community in Kuwait for attending this event and making it a success. The Embassy hopes that this event will act as a catalyst and spur further collaboration and cooperation between the two countries, especially in the investments domain. We will endeavor to organize more events in the future to further maintain this momentum and to give a further impetus to the promotion of investments into India from the state of Kuwait. Thank you. Be safe, be healthy, have a nice day. Thank you.